Well, welcome everyone to the Metro Denver Real Estate Trends for the second quarter of 2017. I'm Chris Lopez, and before we jump into all the data, I have two quick things I want to go over. The first is just how we're going to organize our upcoming webinar schedule. Charles and I have done a couple of webinars so far. We've had a lot of fun, and I've gotten great feedback. So our plan is to do 2 a month. The first one will be a rotating topic, and the topics will be like this: trends, deal analysis, just various topics that concerning the real estate market. The second one is going to be a monthly roundup at the end of the month. Think of it as like let's grab a virtual cup of coffee and talk real estate. And it's just no particular training agenda. Rather, we'll have some bullet points there with different stories and news articles and questions emailed in. And it'll be very casual. Let's talk about different things, and we want it to be really interactive. So the place to go for these are the denverinvestmentrealestate.com and go to the webinar section. So on there, you're going to see the upcoming webinars at the top of the page, and all the recordings will be in chronological order below it. So kind of one place to access everything. The other thing I want to bring your attention to is we are actually launching a podcast this week. If you don't know what a podcast is, it's basically a radio program that you can download to your computer or download to your phone and listen to it when it's convenient for you. So if you go to Education Podcast, you'll be able to access them all there. So our first one is actually titled Accidental Denver Landlord to 80 Properties. So there's a really cool interview that Charles did with one of his investor buddies a while back, and this talks about, you know, the good times, the bad times as he's built his real estate portfolio. So our plan with the podcast are to have mostly interviews with different investors and real estate professionals around the Denver market. And it's going to be completely focused on the Denver metro market. So we'll be publishing those twice a month. And look, if you don't know what a podcast is, you don't listen to them, I really encourage you to Google it, check it out, and start listening to them. They are actually my favorite way to consume information. I know Charles listens to them a lot as well. So if you don't know what they are worth spending a few minutes to figure out what they are and downloading and getting familiar with some podcasts, because we will have some really good interviews on there as well. All right, so moving on to the webinar now. Charles Roberts, who many of you are familiar with. If you're not, he's the president of Your Castle Real Estate. He's a very successful investor himself, and he's a realtor with an investment niche focus. And today, Charles is going to go through the latest data and trends for the Denver market. So Charles, why don't you grab the screen and take it away?
Great, thanks, Chris. Tell me if we are on now. Can you see my screen?
I can see it.
Okay,
good to go.
Great, thanks everybody. Appreciate it, Chris, for setting this all up. So, yeah, I have a lot of fun doing this. I hope everybody has a really, really good hour. And if you've ever been to any of our classes or webinars or anything, you'll know the first thing I always start with is please ask questions. I want this to be a great use of your time. I am going to talk about what we're seeing in the Denver market, what we're seeing for the future, but it's much more fun when you hit me with questions and we really got to think about it. So please don't hesitate. Chris will be helping me out. He'll be looking at your email questions and jumping in every now and then and say, Charles, stop. What do you think about this? What do you think about that? So without further ado, let me start in and talk about what's happening in the Denver market. So this right here is our screen showing prices. You should be able to see 1971 up to present day. And this is, I always start with this slide because this gives us an idea of what's happening market and what has happened for the last 45, 46, 47 years coming on now. And what you see is that over time prices go up. It's really that simple right here. Our average annual appreciation is just over 6% for single family homes. It's a little bit less, about 5.9% for condos and townhomes. And you see that prices go up, they flatten out for a while, they run up for 17 years, they crash, and all of you who were with me during this crash know what it's like to go through a market crash. Very unpleasant. And we started going up again, and then you see that we've just gone up and up and up. And right here, this is the last couple of quarters, the last The June 30th, 2017 data, the average price of a single-family home in Metro Denver, believe it or not, hit $486,000. So all of you guys out there, and I see the folks who are out there, I know a lot of you guys are investors, Scott and Tom and other people, own a lot of property, you're making tons of money, good for you, and that's probably why you're here. So prices have continued to go up. The question we get all the time, of course, is will they continue to go up? What do we see in the market? So give me a couple of slides here and we'll jump into that. Denver condo prices, basically the same story. If you look at both slides, they go up, they go down a little bit, they go up, they go down, and they are now at record highs by quite a bit. Incredibly, once again, the average price of a attached condo or townhome in the 7-county Denver metro area hit $282,000 in June. So those of you who own these properties, I'm sure you're very happy. Buy and hold's what we like to do. Here's an interesting way of looking at the market that does give us a little data. We broke it out by the size of properties, and there's a lot of stuff here. Let me walk through this. This is the smallest 10% of the properties that we got off the MLS sold during these periods of time, and then they get bigger and bigger and bigger. So this right here, for example, is the smallest 10% of properties in 2011-12 went up 17%, whereas the largest properties only went up 2%. And you can clearly see the patterns here. It's been the smallest properties who have year over year gained the most appreciation over time. And it's been the largest properties, the largest by square footage properties, that have not appreciated as much as the smallest ones. And it's a perfect continuum here. You see the smaller ones. So those of you who bought a whole bunch of properties in, I don't know, Denver Southwest, maybe Commerce City, Aurora North back during the downturn, you've just made a ridiculous amount of money during this period of time. On the luxury larger stuff, prices have gone up, and that's good news overall, but they haven't gone up as much. Really, really interesting data. Like we said, if you have any questions, anything you want me to talk about, just jump in, type it, and Chris will point it out, and we will start talking about it. This is the inventory of single-family homes going back 9 years. It's a slide that I really like talking about. I know a lot of you have been to our classes in the past over the time, and you've seen this before, but it's updated, which is great, because here's July 17. So let me tell you what's happening here. This right here is the active inventory on the MLS during this period of time. So in January 2008, there were about 25,000 properties on the market, and we sold, 3,500. And then a couple of months later, we hit 27,000, we sold about 5,000. You can obviously see the trend. It's such a great description of our market, of what's happened. When you have a lot of properties on the market, it's a buyer's market. And those of you who were in our market 10 years ago, 9, 8, 7 years ago, you saw what a buyer's market was. And then look what happened here around 2012. The market really shifted, and remarkably, we've had an incredible seller's market for 5 years. And it's way longer than I had thought it would last. When I was teaching this class 5 years ago, and we were right about here, my guess is we'd have a couple of years is what I thought we would have. And then I thought a bunch of inventory would come on the market, and the red line would come back up. And that just simply is not what's happened. We have so little inventory. Look at this right here. During these periods of time, we have the same number of properties on the market as we have sold. Amazing. And again, amazing. And you know what we're into right now? This is June and July 17, the exact same situation. So if you're wondering, is this market new? Is it so different from last year? Is it so different from the year before? It's actually not, and which is why it's so important to take a perspective of the market, to understand, maybe you just jumped in the market last month and you suddenly think everything is different. Well, those of us who've done this for a while, you say, yeah, actually it's been about 5 years. It's been about 5 years of an extraordinarily strong market. The question, of course, is it going to continue? I will give you my 2 cents. I'm the first one to say, I don't know. If I knew, I'd be charging $1 billion for my advice. I would know the future, but I don't know. But I'm going to guess. I actually think this is going to continue for a while. I'm going to show you some more slides about population increases and a lot of things that are very strong in the Denver market. We just don't see any evidence of anything changing. And if that sounds familiar, for those of you who were taking this class a couple of years ago, it really should, because it's exactly what I said here and what I said here is that, you know, in the next few years, we're just not seeing anything to suggest our market's going to change. Not that this is evidence, but in the last year and a half, I decided to buy some more properties. So I've been doing this for 20 years. I've been an investor for 20 years, real estate agent for 13 years, built up your castle. We bought Live Urban Real Estate. I'm the president of that. I do a lot of real estate stuff. I decided to buy some more properties. And I started again about a year and a half ago, and I bought 6 more little condos and townhomes around Metro Denver. I bought 3 in Green Valley Ranch and 3 in the Robin Wood complex of Aurora South, you know, right about here. Not like I was trying to time the market. All I can tell you is I had no reason to think it's a bad time. The cap rates were good. The cash flow was good. I'll hold these properties for a long time. So for what it's worth, I wouldn't have bought 6 properties recently if I thought the market was going to crash. I don't. We'll see what happens. But that's my best guess, is everything is pointing to this continuing for quite a while. Thanks for the people who've recently joined in. And please, if you have any questions, just type them in, and Chris will stop me, and we will handle a couple of questions. So
yep,
what this...
Okay. Can I go and jump in, Charles?
Yep, of course.
Cool. So we got a couple here. So flip back to the previous slide on the square footage, and Jim asked, small properties are under what square footage?
It's actually the smallest 10%, and hey, Jim, thanks for joining us. It's the smallest 10%. That's how we cut them. So I actually don't know what I don't have it here, what it is. I'm sort of literally scratching my head. It's probably under like 1,100 square feet, but we broke it out into different buckets. The smallest square footage, 11 to 25%, up to the largest 10%. That's how we break it out.
Lex asks, I believe the source you use to determine your annual rent increases is a paid service. Can you provide a second source?
Yeah, I use a lot of different sources, and there are some good ones. I tell you, and especially for you agents out there, you're going to hate this because we're all taught to hate Zillow, but Zillow is great. Zillow has pretty darn accurate rent comps. I really like them. You just type in the address and you do like a Z estimate, and it gives you the rent. I find Zillow a lot more accurate for its rental comps than for its Z estimate sales or whatever, you know, market value. I don't know why. I don't know their back-end algorithm, but I would just start with Zillow. I would start with Zillow, then maybe go to Craigslist and look in the area you're looking for, but that's exactly what I do. And then from there are paid services, but Zillow's pretty good.
Cool. And one more question we'll get to now, Charles. Tracy wants to know, will these slides be available?
Yes, I can make them available. I can send you a PDF of the slides. So, Chris, should they email me or you?
They can email me.
Okay, and do they have your email?
It's simple. It's chris@denverinvestmentrealestate.com. And if it's okay with you, Charles, actually just put that in the follow-up email we send out to everyone.
Yeah, that'd be fine. Yeah, we'll send you a PDF of the slides for sure.
Cool.
Okay, so let's talk about affordability. So many of the slides that we create are based on questions that you guys asked over the years. This one is particularly one saying, hey, our price is too high. Is Denver no longer affordable? So let me spend a moment on this and tell you what's going on. It's really a great indication of affordability. What we did is we went back and looked at the debt to income, the average debt to income in Metro Denver going back to 1971. And actually it took quite a bit of time for us to put this together. Long story short, what you see is that in the early 80s, it was very, very unaffordable to buy property in Metro Denver for the simple reason that the interest rates skyrocketed. Very unaffordable. As the interest rates came down, you can see that it became more affordable. And you've got this period from about 1993 to about 2007, interestingly, where based on our numbers, the affordability was roughly the same. Part of the reason is while prices went up during this period of time, interest rates came down, and income also went up, making homes relatively stable in terms of affordability. And this is the type of thing you just won't see anywhere else, but this helped explain the market to ourselves. So what happened during the downturn? During the downturn, 2007, all of a sudden homes become incredibly affordable. Everybody likes to conveniently forget that, but that's exactly what happened. Why? Because the prices plummeted. Suddenly homes were very affordable, and they stayed affordable during this 2007 to 2012 or so period where hopefully a whole bunch of you bought properties, because in retrospect that was the time to buy affordable properties. So what you hear now constantly is that Denver is not affordable. And the way I break it down is this. If you read a news article that says Denver is not affordable, hey, look what happened since 2012. We went from 30 to 50% debt-to-income ratio. Then yes, absolutely, we are much less affordable today than we were during the record affordability area right about here in 2012. But I think it's a more intelligent way to view the market to actually look at a 45-year average. And our 45-year average was right around the 45%. And the truth is, based on our data, and it's really objective data, we're not trying to lead the witness here, we are at about the average affordability we have been. Now, is this going to go up? Is it going to be less affordable over time? Yeah, I absolutely think so. I don't think interest rates are going down much anymore. I don't know what they're going to do, but I don't think they're going to plummet. And I do think prices are going to rise. I think that this number is going to go up. And sooner or later, we are going to reach some sort of maximum affordability. But this, to me, suggests we're at about a 45-year average for affordability. So that's not something that overly worries me. And if you just want evidence for this, put a house on the market. You put a house on the market at $482,000, the average price, you've got people coming out of the woodwork trying to buy it. So we can say that it's less affordable than it was and that prices are at their all-time high, but we are closing deals. We do not have enough inventory. We have more buyers than sellers. That, to me, suggests we are still a relatively affordable market based on the incomes in Metro Denver. And Chris, go back to you. If you have any questions, just jump in. If not, I will go to the next slide.
Yeah, we got a couple of questions, and if you want to save these to the end, just let me know. Cindy asked if anyone is buying outside of Colorado. I know that can lead down a rabbit's hole, so.
Yeah, Cindy, the answer is yes. I mean, of course they are. It's a very common question. And, you know, I won't go down a rabbit hole, but I will tell you a couple things. One, for example, I think we have Tom Herford on, and Tom, I won't talk too much about you, but I believe you are doing stuff outside of Denver, so if you want to chip in with anything, we'll read your answers. But yeah, sure, there are people doing it. There is no question that the whatever metric you want, cash flow, cap rate, return on investment, is higher in lower priced areas. Go to Baltimore, go to Detroit, go to St. Louis, go to Albany, go to Philly. If that's what you want to do it, and I really mean that. What I would be aware of is third-party aggregators that, you know, sort of have a weekend seminar and say, give you their money and they'll take care of it. I have not seen good results over 20 years of people doing that. Have somebody on the ground, know what you're doing. But you can absolutely get better cash flow outside of Metro Denver and outside of Colorado. But I would say it comes with a risk, and when you've done this long enough, you see a lot of people take risks and chase money and regret it. So that's kind of my 30-second answer on that. Happy to talk more about it if you want to contact me.
And another question here for you, Charles. Actually, Tom says, have you compared the trends in Denver to Seattle or San Francisco as far as the trend pattern, since they are a few years ahead of the Denver market?
You know, Tom, by the way, Tom, we got to catch up. It's been a while. No, we haven't. You know, there is a sort of limit of the amount of time that we can do this. Hey, if you can do it, I'll put the slide in, put your name on it. But yeah, you know, San Francisco, outrageously expensive. Seattle, who just actually put a 4% city tax. I'm sure you know all about that in Seattle. I think above 200,000 singles and 400,000 married. They put a city tax. We'll see how that affects the market. The answer is no, we haven't. Let me know if you got something. I'll add it to the presentation. I'm sure people would find that interesting.
All right.
Should I go on?
Yeah, go on to the next slide, please.
Okay, mortgage rates. So just a quick one on mortgage rates. It's not very difficult to predict mortgage rates. It's absolutely and completely impossible. And if you disagree with me, I will go toe-to-toe. I will argue, and I promise you I will win. You can't predict mortgage rates. Anybody who tells you different is selling you something. Like a real estate agent saying, hey, you should buy now because interest rates are about to go up. It's just not true. It is absolutely impossible to predict them. That said, let's just look at the history. This right here is 7 years of history. Here's the last couple years. We are no longer at 50-year lows. We're at 48-year lows. Interest rates are very, very low. My feeling is, over the long term, if you were to buy as an investor and get a 4.75% interest rate on a 30-year fixed loan, you probably will be really, really happy. But please do not buy today because of interest rates, or not buy because of interest rates thinking you know what tomorrow is going to bring. We don't know. Nobody knows. And it's just, I know I'm sounding kind of harsh, but it's something I feel really, really strongly about, is that don't try to predict interest rates, and don't listen to anybody who says they can. And by the way, as always, willing to debate that one. If I've got a loan officer or someone on here who can prove to me that they can, well, I'm here to learn too, so please let me know. Okay, supply and demand. I'm going to talk mostly about the demand here. We live in Denver. I don't know how many of you are from Denver, but if it's typical of my classes, it's less than 50%. I'm not. I'm from Boston, great city. I'm living in Denver. Why? Because Denver is awesome, and everybody wants to live there. And our population has grown dramatically. Just drive down I-25 or along I-70, and you know what I'm talking about. And it's expected to continue growing. So while we may all complain about the traffic and complain how Denver isn't what it used to be, etc., we real estate investors are making a great deal of money because there is simply more supply than demand. This right here is from a colleague of ours who puts this data together, Patty Silverstein. She's a demographer in Denver. And what this tells us, based on her estimation, is, for example, in 2016, our population increased by about 50,000 along the Front Range, 7 County. And what that was about 20,000 births over deaths, positive, and about 30,000 more people moved to Denver than left. So maybe 40,000 moved to Denver and 10,000 less. And this is her best guess, that she thinks we're going to add about 45,000 people per year for the next 10 years. Strangely, of all the reasons I continue to buy real estate, this is honestly one of them. These people got to live someplace. Read the Post, read the Business Journal. All you hear about is the housing crisis. And it is a crisis if you're a renter and you're trying to buy a house and you're a nice person. If you're a teacher like my wife is, making $52,000 a year or something, it is a crisis, and I feel for those people. But I'm also an investor, and I would rather be someplace where there is more demand than supply. This right here is a very, very important slide. There is simply more demand than supply in Metro Denver. Chris, any questions?
Yeah, we got a couple here. Tracy asked, her 20-year-old son just sold his truck and has some money to invest. We talked about buying a 2-bedroom condo and having a roommate. Roommate pays rent to pay off the mortgage. Son builds equity with tax deduction, works in Parker. Where would you advise him to buy? Which city?
Okay, well, first of all, I love it, love it, love it. We sort of call it house hacking. That's kind of the new term for it, although people have been doing that forever. Absolutely love the idea of your son getting in as an owner-occupant. He can put 5% down. If he's well qualified, he can probably get a loan at 4.25%, and he can almost live for free. So absolutely have him think about it seriously. It's not a simple question where to buy, because he's going to live there, and presumably he wants to live someplace he wants to live. What I can tell you for sure is if he buys in a lower-end neighborhood, he's going to make more money monthly. No question about it. That's the way it always works, whether you're just an investor or you're house hacking like he is and living there. So if he wants to make the most monthly return on his investment, it would be your sort of Aurora North type of area. If he wants to live in Parker, he's going to make less money. It's a continuum, and what you want to do is you want to reach out, you want to look at properties, talk to an agent, go look at properties, do the numbers. But what I can guarantee you, if Parker is more expensive than Centennial and Centennial is more expensive than Aurora South, his monthly return is going to be best in Aurora South out of those three. But maybe he wants to live in Centennial, fine. He makes $70 less a month, but he lives where he wants to. That's important too.
All right, one more question here from Cindy. She says they are thinking of buying a second home in Franklin, Tennessee, which is just south of Nashville, and running it on VRBO. Any thoughts?
Yeah, I mean, I'm no VRBO expert, and I'm really not an expert in Franklin, Tennessee, so can't say that. Just make sure they know what they're doing. I mean, make sure they have someone on the ground who can take care of problems. VRBO, phenomenal cap rates. It's a really, really great opportunity for investors if they know what they're doing, if they have someone on the ground who can help them, and if they're willing to, take a few hits, because they're going to take a few hits. So I really like the idea, but I don't like the idea if they think it's not going to be a problem. You don't get a 15 or 20% cap rate without problems. You have to earn that money, and that money means you need to have some problems. So really like the idea, but have them explore it. If I was them, I would fly out there, I would meet with a bunch of people, I would talk to people in investor clubs, try to find someone who does the cleaning, who does maintenance. Make sure when they get that proverbial 2 in the morning phone call, they're prepared for it. Otherwise, they're going to be really unhappy. But let me leave with a positive. It can be great if they just have someone who has an interest in helping them on the ground there. Okay, Chris, if it's okay, I'll continue on this slide right here. Really like this slide because it's just basic math, but nobody thinks this way unless you see it in front of you. So this is one to my colleagues who are real estate agents, mostly, and a whole bunch of you are real estate agents. This is a type of back-of-the-envelope thing that you want to talk about, at the next cookout or when you're having drinks with someone, because it's really incredible how you can make money in real estate without taking any huge risks. So let me just walk through this. Let's say you buy a house. $250,000 house or condo, just a basic, simple property. Let's say you're qualified, you put 5% down, your down payment's $12,500, you got a job, you have 2 years of job history, you got a 720 FICO, you're just a normal person, you got a 4.25% interest rate for 30 years. Your payment's going to be $1,107. So what you're not seeing here is knocking on 10,000 doors, is going to investor clubs, is talking to the weekend gurus, just buying a darn house for $250,000. That's all we're doing here. And this is your owner-occupant. You're putting 5% down. Let's say over the next 10 years we have 5% appreciation. Now again, we had about 6% in the last 45 years. Nobody can predict the future, but I'm willing to guess that in the next 10 years we'll have 5% appreciation over time. I'm guessing we'll have 7, 8, 9 for the next couple of years, then maybe it'll go down a little bit. We might have a couple of down years, but overall, when I look at my estimations, my pro formas, I put in 5%. I personally think that's reasonable. So what happens is you have appreciation and loan pay down, and let me walk through this. So this right here in black is the home value. Day one, you pay $250K, and as it goes up 5% over time, it ends up over here, above $400,000. It's incredible, but that's the math. It goes up 5% a year. That's the money you make. Right here is your loan. This is your mortgage. So it's $250,000 minus $12,500, which was your down payment. So what's that? $237.5, I think. I'm doing that in my head. And then, believe it or not, even with a 30-year loan, you actually make principal payments. So after 10 years, you only owe this amount here. And if you take this plus this, your appreciation goes like this. You started with $12,500, and after 10 years, with these simple assumptions, you actually have over $200,000 in equity. And I'm telling you, if you don't do this every day, it's shocking. You don't believe my math. You have a hard time understanding. But this is why so many people make so much money in real estate. And I'll tell you, a lot of the people who make so much money in real estate can't even do this math. They don't even understand it. I didn't for the first 10 years I was an investor. I couldn't have talked about this until we came back and started doing the numbers. Just putting $12,500 down on a property with the basic assumptions we made, you have well over $225,000 in equity in 10 years. Just think about that. Do the math. Call me if you want to talk about it. Tell me where else you can get a 1,700% ROI. Yes, you're going to have good days and bad days. Markets might go down for a few years, but over time they tend to go up with inflation. 5 or 6% is what we think they'll do over the long term. Really, really powerful discussion. Chris, I'll stop. Do you have any questions?
Yes. We got one from Mandana, and I apologize if I mispronounced your name, By any chance, can
I'm
you
done.
talk about where multifamily is and where it's going in the next 5 years? Is it similar to what we're talking about now, or is it completely different?
Yeah, hi, Vandana. Nice to hear from you. I'm not an expert in multifamily, but I can tell you that the prices are outrageous, and they're going to probably continue to get even outrageouser, if that's a word. I have no reason to think that multifamilies, and let's define it as 5 plus. I mean, technically a 2-unit is a multifamily, but generally we think of 5 plus as multifamilies. My best guess is their prices are going to continue to go up. Now, what's interesting, at least for me and my clients and my crew, is that we don't really buy multis because they're so expensive right now. I'll have clients come to me with $1 million and say, let's go buy a 10-unit, and I'll say, great, I can get you a 5 cap, or you can buy a bunch of 1 units and get you a 7.5, 7.3, 7.6. And unfortunately, I go for myself, we tend to buy small properties because they simply have better cash flow. There's a great deal of money out there. There's a great deal of interest in that, and 7% unemployment rate. I think the prices are going to continue to go up. Now, are they going to go up more or less in multi than single? No idea. That's just way past my pay grade. I think they're all going up for a while until we see something in this market that changes, and we haven't seen it for a long time.
All right, that's it for now, Charles. Keep on going.
Okay, so this is some CoreLogic data that's just really interesting. I pulled this slide talking about different states. We might have some people from different states on this. Really fun to do a webinar and have that perspective. And what you see here is the dark blue ones, if that's blue. These are the states that have appreciated the most in value. Over here, we're seeing a lot of Manhattan and the 5 boroughs accounting for the 7.9%. I don't think Albany is going up that fast. But what we're seeing here is Colorado has clearly been a leader the last several years at 8.4%. So I think it was Tom brought up Seattle, and you're right on, man. Washington leading the country at 10.5% appreciation. I might be doing some work up there. 9.9% in Oregon, Idaho, etc. But we are in the top 4 or 5 in the country. Does that mean things are going to turn someday? I mean, you could make the argument you should be buying in West Virginia. It's almost flat. Pennsylvania is almost flat. Connecticut, this is a great one. A lot of discussions about Connecticut. Only state in the union last year that actually had a depreciating prices for real estate. Would I buy there? Not really. I used to live there. No, I'm going to buy here. We'll see how long this lasts, but it's kind of neat to see the average price increase in the U.S. was 6.7%, and we're 1.7% above that. Not skyrocketing above it, but we're definitely leading the upward march. Now let's talk about home ownership rate. So a lot of you guys are investors, I know that. So let's look at what we've seen since 1965. This is the percentage of Americans who live in homes that they own versus rent. And what you see is that in 1965, 62.9% of Americans lived in homes they owned, and the rest, pretty high number, about 38, 37%, rented. And we saw some trends over time. We saw, for this 15 years or so, home ownership rate went up. And then, as interest rates skyrocketed, that really affected the home ownership rate. As we saw before, it was simply unaffordable to buy. So home ownership rates went down. And then we see this incredible upward march that really is due primarily to the lending practices, which is a whole other discussion. But it's an intertwining of government policies, of lending practices, and of a worldwide consumption of American loans that really fed her. And it reached this zenith here of 69.2%. When we hit almost 70% home ownership, which many of us thought was a good thing. People own homes, that's a good thing, but unfortunately what we saw during this period of time is, unfortunately, a lot of people who were just not qualified, kind of finger quotes qualified, call it what you will, the people who in the past would not have been qualified to buy a home, money was free, money was easy. They bought, and as soon as the market turned, it crashed, and you have this perfect bell curve. It went up to 69.2, and it's right now back. It ended 2016 literally where it started in 1965. So who is this good for and who is this bad for? Well, obviously it's terrible for all the people who lost their homes. Whether they made a mistake, whether they were misled by lenders or the market or USA Today or whatever the heck it was, this was very, very difficult period of time. Every percent is about 1.2 million people, and a lot of these people lost their homes. Who is this good for? Well, a lot of people on this call. You investors, this is good for you. There's simply no way around it. All of these people who don't own, they rent. And that is exactly why Denver is not unique in any way. There are simply more renters than there are rental properties available in the U.S., particularly in Denver. That's why rents have skyrocketed. That's why it's a renter's market. Now, you guys who were investors back with me when I had, right here, I had 29 properties right here. Let me tell you, it sucked. It sucked to rent. We had 13.4% vacancy. Why? Because it was easier to buy a house than it was to rent. That was very, very tough on the landlords. Not that anybody in the world cares about the landlords, but I'm sure a few of you are chuckling because you went through what I went through, and you had to work really hard to keep your places full. You don't have to work that hard anymore. You should, but you don't have to, because we have very, very low vacancy. And my guess, just a guess, is I think it's going to stay low for a while. Nothing suggests to me that this is going to change, and that's why it's going to be a lot of fun to be a landlord for a while. Chris, anything?
Yeah, one question here for the statistics here, like this, 63% or so. Is that, do you know, is that all Americans or just like adults between a certain age? I'm curious to know if that's the entire pool of the U.S.
Yeah, I believe it's the entire pool. So this is U.S. Census data, so promise you we're not making this up. Percentage of home ownership. My understanding is of all Americans, it's the number that live in homes that are owned by, the head of the household, whatever you call it. But this is the basic data that you see. So there's probably a better definition. Go to the uscensusbureau.com or something and you can get that. But you can see the trend. It goes up and it goes down. Right now we're at close to an all-time low, which means we're at an all-time high for the number of renters.
Great, thanks. That's it for now.
Okay, so let's dig into some of the investor stuff here. This right here is the average price per unit going from end of 2007 to today. And what you'll see is it's really incredible. And again, I know a lot of you folks on the call and a lot of you guys own this property. I own a bunch of duplexes, and I saw this. I saw my duplexes go from $115,000 per side. So right here, the purple is 2 to 4 unit properties, price per unit. So that means this was a duplex. The average price was $115,000 for a duplex. We saw it go from $115,000 per unit, so $230,000. We saw it go from $230,000 down to $144,000. Do the math. That is not fun when you see your portfolio go down 40+% in value. And I saw my portfolio go down. So no one's going to call me a hopeless optimist. I've seen the worst downturn in Denver history. I've lived it. I own 29 units. I know what it's like. It's very, very tough. I'm very conservative now because of it. This is what happens during a crash. The prices go down 40+%. For the 5 units, they didn't go down as far, averaged 77,000 down to 49, but still went down a lot. And congratulations for all you guys here who bought some units while the prices were low and everybody was too scared to buy and everybody said don't buy real estate, etc., etc. Because look what's happened. We hit a low of 72,000 per unit, which means a duplex was 144. We hit 208,000. We're at about $200,000 per unit. We have more than doubled. Off the top of my head, I don't know what's that, about 2.5 to 2.8 times, whatever it is. Astronomical. And I promise you, if I'd been teaching a class in 2011, I wouldn't have guessed it would go up this far, this fast, for this long. Welcome to real estate. Really hard to predict. But we buy and hold. And we advise people to buy and hold, to not try to predict the market, to understand the market and understand that it's very hard to predict, because if you can survive this downturn and you are putting yourself in a position for an upturn, you can make a lot of money. And that's exactly what happened during this period of time. Any questions?
No, keep on going.
Okay. This right here is the Market Trends Rent and Vacancy Report put together by the Apartment Association of Metro Denver. On the top, you see our vacancy rate by quarter, And over here, you see the median rent by quarter. So what you see is when the vacancy rates go up, like they did in the 80s, the rents stop going up, maybe even go down a little bit. You have 10 years where you have virtually no increase in the rent, and this is real dollars, which means the inflation rates were high during this period of time, which means the real income was going down because the dollars were being deflated, but you were getting the same dollars for a decade. Tough time to be a landlord. Vacancy rates go down, rents skyrocket. 12 years, they go up 9.5% a year. Incredible upturn. And by the way, you'll notice that it's not like every month or every quarter or every year things change. So when you read Zillow, when you read Trulia, when you read the Denver Post, and they say, here's what's going to happen next month, just forget about that. Think in terms of decades. If you want to be a real estate investor, I suggest you think in terms of decades, not trying to predict next month or next quarter. And just look here. You see about 10 years of this, about 10 years of this. Then we have a spike right here in the vacancy, and you see the rents go down. And right here, we got about 12 years of flat. Once again, over a decade of flat. And then vacancy rates go down, and this is what you've seen the last 4 or 5 years, over 10% increase in rents. So once again, to look at it in perspective, what you see in the media is always about how high rents are and how fast they've gone up. Why? Because they have to sell. They have to sell newspapers. They have to sell clicks and eyeballs. They have to say something sexy. It's pretty sexy to say rents are up 50% in 4 years. What they never seem to tell you is that the average rent is up only 4% in the last 45 years. 4% doesn't even keep up with inflation. Do I think rents can continue to go up? Yes, I do. Now, of course, we all know wages haven't kept up with the rent increases, or certainly not the home prices the last few years. We'll see where that will go. But I think it's really important to understand that rents have only gone up 4% over this long period of time. Basically, we're making up for the 12 years right here where my rents didn't go up. And let me tell you, that wasn't a lot of fun. As a landlord, this is a lot more fun. Any questions?
We got a couple, but I'll save those towards the end. I think they'll be a better fit at the end of the webinar.
Okay, well, we actually are at the end now, so I wanted to make sure we had plenty of time. You get another 15 minutes or so, and thanks for the questions. Keep them coming, and just appreciate it. Hit me, Chris.
All right. So this is a follow-up question from Cindy, who asked earlier about buying outside of Colorado. She wants to know, where are people buying outside of Colorado? You got any insight into that, Charles?
No, I really don't. So I'd ask you guys. We got dozens of people on here. We got a whole bunch of people on. So maybe you guys can throw it out there. I can tell you, I've heard of people Philly, Detroit, St. Louis. I mean, I'm not an expert in it, so I can't give you too much, but I'd be happy to have anybody who has some information throw it on, and I will relay it back out to you.
I've seen a lot of people just on various blogs I follow. A lot of people are in Memphis, Tennessee. A lot of turnkey providers out there, a lot of people investing out there.
Great.
Chuck adds Cleveland.
Great.
So I think as just an overall picture, I think a lot of it's just kind of those, the Midwest states, Tennessee, Kentucky, Ohio, places like that where real estate prices are very, very low.
Yeah, and that's really what it comes down to is both in Denver, the lower price property in the lower end neighborhood is going to get better cash flow. And it's the same thing in city per city. You're going to get better cash flow in Detroit than Denver. If you want to invest in Detroit, absolutely. Just look at the pros and cons, look carefully, and maybe you want to invest in Detroit.
And I actually just had a discussion with this with someone the other day, and I had looked at turnkey investing last year or the year before as a way to invest. And what stopped me from investing out of where I live was I realized I'm too much of a control freak. I simply don't trust, people I haven't met, or I don't know, to trust the word on the house, the work they did, managing it, putting tenants in there. I'm a control freak, and it just really, as I thought about it, it just rubbed me the wrong way. And I like to have a place I could drive to, or at least somewhere that I knew someone and I went to regularly on vacation at the very least.
And I do think that makes sense. Like I said, I don't want to dissuade anybody from buying out of Denver. I don't want to persuade you to buy in Denver. Do what's right for you. But don't think for a minute, don't be so naive as to think that real estate is a hands-off investment. Buy bonds. You don't want any work. You don't want any risk. You don't want a bad day or a bad month. Buy bonds and get the return from bonds. You want to make an above-average return. I promise you, you're going to have bad days and bad months. Ask any real estate investor. But that's where the money is, and that's just a decision that we all have to make.
So a follow-up question on there. Are you still buying condos, townhomes, and single detached homes in Denver currently?
Great question. So I started again on this another round of buying in January of 16, and then I bought through January of 17, so over that year. So basically a year and a half ago, up to a year ago, I bought 6 properties. They were in Denver, Denver and Aurora South, between 133,000 and I think 171, and they were all attached. What I found is about 2+ years ago, the market changed where maybe 4 years ago, 80+% of what we were buying for cash flow investment properties were single families. Now, 95% of what we're buying are attached. We're just finding the cash flow is better on the attached property, so it's a market we needed to learn, and that's exactly what I bought. I never owned an investment property in Metro Denver that was an attached condo or townhome until January of 16. I'm loving them, loving them, loving them, and that's what we're doing. And I got a couple of folks on the webinar who are clients of mine who got them under contract right now. Doug, I see you on there, and that's what we're buying now. We're just not seeing the returns on the single families. They're just too expensive at this time. My guess is in a year or two we'll see that change again.
Well, I think you also answered the next question. Doug had actually asked what's your opinion on cash flow and cap rate returns on single-family detached homes versus condo and townhomes. You want to elaborate more on that, or?
It's pretty much it. I would love to be buying single families. I have some clients who would prefer. They're afraid of HOAs, whether that's logical or not. They may very well be, and there are certainly some scary things to deal with on HOAs. We're just not buying them. They're just too darn expensive. So whereas I think, Doug, I can't remember, I think yours is like a 7.2 cap, the one we just got under contract. I mean, we're getting a lot of like mid-6s to low-6s on single families, unless we want to go up to Brighton, or like a bad neighborhood in Commerce City where a lot of my investors don't want to buy. Nothing against Commerce City, but just some of the lower-end neighborhoods. So I'm thinking 95+% of the properties we bought recently have been attached. I closed 52 deals in 2016. I know that off the top of my head. Almost 40 of them were what we're talking about, cash flow investor deals, and not one of them in 2016 was a single family, incredibly enough.
So Vandana asks, would you sell and upgrade to bigger and better upcoming areas, or are you always a hold forever old-fashioned way?
Yeah. So, Vandana, I'm going to answer a question with a question is, you tell me what's a bigger and better upcoming area. To suggest that you know what neighborhood will outappreciate what neighborhood, I challenge that. As you know, Vandana, you were an agent at Your Castle, a wonderful person, very intelligent, got all that. We run all this data. This is what we do, and we don't buy that way. We don't try to figure out the next great neighborhood. So my answer is no. If you're asking, I can tell you I bought 3 in Green Valley Ranch and 3 in Aurora South. I mean, not exactly the great upcoming neighborhoods. You might call me a fool, but that's what I did. So I guess, do what you do, not what people talk about or whatever. That's what I bought because I was comfortable in those neighborhoods and I liked the cash flow. But I would be very careful of anybody who tells you you should buy here because this is an upcoming neighborhood, like somehow you've figured something out that 3.1 million people on the Front Range haven't. That's just not what I consider prudent investing.
So Cindy asked, how much fix-up are you having to do on these properties to get them ready to rent out?
Okay, great question. So of the 6 that I bought, 4 of them were like perfect. And 2 of them, I had to put like $6,000 to $7,000 in. I got my guy Dave, who I say, Dave, go and do this, and he does it. So that's what it was. 2/3 of them were ready to go. What I find, I'm not sure if you're a newer investor, but if you are, I guarantee you will over-improve the property when you buy it. We all do. I did that on my first one. Everybody does. You know, hear me now. You don't have to improve it that much in a market like today. So it depends. The interesting thing is 5, 6, 7, 8 years ago, when we were looking for property, we had this delicious choice because we had 25,000 properties in the market. So I had some clients who wanted ready to go, already fixed up, ready to go. I had other clients who wanted to add value to the properties. Maybe they were fixers or something like that. Today, there are so few properties in the market, there just are almost no fixers on the market. It's such an interesting thing to see if you've done this for a while, that I absolutely have clients who are handy, who want to add value and buy it a little cheaper, and paint and carpet and, you know, some kitchen stuff. There's so little out there. For the most part, what we're seeing out there are fixed up properties. That's been what I've seen.
So a follow-up question from Doug on the HOA. Do they actually mitigate some risk? For example, if you own a single-family home and it needs a new roof, you're out of pocket for the whole amount. On a condo, though, the new roof is split between all the occupants, so it works a little like insurance, and you spread the risk and expenses over several owners.
Yeah, well, you answered the question. Clearly, that's exactly right. So does that mean you should buy with an HOA? No. Does that mean you shouldn't buy with an HOA? No. They're just different. But let's look at the downside to HOAs. The HOA president steals all your money and, you know, goes to Mexico with it. Yes, these things happen. Do a Google search. You'll see that they happen very, very occasionally. Most HOAs are reasonably well run and they're doing okay. On the flip side, you know, you got a single-family house. You have a bad roof, man, you might be into it for $10,000, where at least you were getting your HOA fees all the while. You don't suddenly have a $10,000 fee. Here's what I'm going to say. I feel very strongly that there is no absolute reason to buy a property with an HOA or to buy a property without one. It's not like, oh, all the smart people just buy single-family homes, or all the stupid people buy triplexes, or all the smart people buy condos. It's just not that simple. The market is very, very liquid, and I have clients, very, very smart clients, people way smarter than me, and they buy some of each. They buy what's right at the time they want to buy it. What we seem to be finding in the last couple of years is the HOA properties seem to be giving us a better return. That's why I just bought 6 of them. But I would say that be wary of reading a book that says only buy condos or never buy condos, and vice versa. Only buy single families or never buy single families. It's just not that simple. Learn the market, talk to people like me, talk to your colleagues. You can do better than that.
All right, here's an interesting one for you, Charles. This is from Tom. He asked, what are the profile of the sellers for the last 6 properties that you bought?
Okay, so speaking of the smartest person on the webinar, hi, Tom. So the profile, let's see, actually 2 that we, well, let's see, all over the place. Come to think of it, I'm trying to think. I think 3 of them were owner-occs. 3 were investors. 1 of them was an investor who bought 25 properties during the downturn. She and her husband bought them, and I had a client buy one. I was the buyer's agent. She was the seller listing agent. It went really well. She liked me so much, she asked me if I wanted to buy another one from her. My client already had another under contract, so I bought that one kind of all over the place, and I think that's probably fairly representative. I will tell you, the last one I bought in Robinwood, the seller was an owner-occupant seller. He paid $43,000 for this property in 2011, 1,177 square feet, 3-bedroom, 2-bath. What did I say? I think $43,000 he paid for it. I paid $137 for it, I believe, and I was thrilled to get it. It was like a 10 cap. Like, I was the happiest guy, and this guy tripled his money in whatever 6 years. So, Tom, it's all over the place.
Are you concerned about Class A finished apartments coming online and hurting the attached values after the construction defect statute of limitations expire?
Yeah, great question. I knew I couldn't go an hour without that question, and it is a really good question. I'll take a couple minutes. I would say In my market, I'm not. What me and my clients tend to buy is, class B minus, C plus kind of stuff. Not to say it couldn't eventually reach that far. What I would say is that there is reason to believe that over some relatively long period of time, given the construction defects legislation that was signed a couple of months ago by the governor, there may be more rented attached properties put up for sale and competing on price with properties in the market. I feel relatively insulated. I'm buying in $130,000, $170,000, $210,000 areas. It could cascade eventually, but it doesn't really make my top 50 list of things to worry about. Like a dishwasher that goes bad. I had one go bad today. My guy's there fixing a dishwasher. Like, that's the type of thing I think about, because I just don't believe that I, or pretty much anybody, has the knowledge to be able to predict what the construction defect legislation is going to do for prices in a way to make yourself a better investor. So I've been following it very carefully. I'll say it again. I just bought 6 properties. I did not buy properties because of the construction defects or not because of the construction defects. I just believe that I cannot know with any certainty what construction defects will do to prices. So I buy properties that fit my analysis, fit my profile. I control what I can control, and I leave it at that.
And as any final questions you guys want to ask, go ahead and throw those in there. We got a few minutes left on the webinar, and I'll just do some last-minute house cleaning while those come in. Had a few people ask me about accessing the recording for this. Yes, there'll be one up. It'll probably be available tomorrow at some point. So if you go back to the Denver Investment Real Estate website to webinars, you can access it there. And also I'll send out an email to everyone that attended with the link to the recording and also the PDF slides as well. All right.
Hey, Chris, I'm reading a question here, if it's okay. We have a client wanting to sell his townhome, but the management company is trying to talk him out of it and will not go over their contract with him. I thought the author creator of a contract had the legal obligation to go over it. So I just want to talk for a second. So I cannot get into legalities. What I can tell you is that if I am a listing agent and an offer comes in, I am bound legally to present all offers to my seller. I'm not sure if that's what you're asking. It sounds a little different because you're talking about the management company trying to talk them out of it and won't go over the contract. So I'm not sure who sent that, but if you want to follow up with me, I'd be happy to talk about it, understanding I can't talk about legal stuff, or I have to be really careful about that, but touch base with me if you want to chat. That's an interesting one.
So another question here for you. Charles, can you talk about how someone would and could manage all the rentals? Do you have your own company, your own management company, or do you hire a company with their maintenance people to run your rental business?
Yeah, it's called, Charles Roberts answering his phone. No, I manage my own rentals. So at my height, back before the downturn, I had 29 units. I sold a bunch, paid them off, bought some more. I've got 15 right now. I can tell you that I manage my properties. It's not that hard. I got a guy named Dave who, Dave has helped me. I help Dave. When Dave goes to jail, I bail him out. When there's a flood going on, I call him. He helps me out. That's what's really, really worked for me, is having somebody who can help me and who owes me because I owe him, and back and forth. We have colleagues. Mark Cunningham is a great property manager from Grace Property Management. There are some terrific property managers out there, and frankly, there's probably also some bad ones. So, like so many of my answers, there isn't an absolute answer. But I can tell you that I personally manage my own. I don't know. Should I be doing something else? Probably. I've done it for 20 years. I'm pretty good at it. My tenants love me. I'm really nice. I help them out. I get paid the rents. We all make money. That's what I do. Not a lot of science here. I just manage my own properties. It's not that tough.
And Charles, if I remember correctly, and please tell me if I'm remembering someone else, but I thought a while back when we were talking, you had calculated you took the amount of money you'd spend on property management fees and divided over the amount of time that you put into manage it, and you came out with I think a pretty good hourly wage, right?
Yeah, it was about 160 an hour, and you know, if I was a PhD student, I could probably get much, much deeper into the calculation. But I basically looked at like 9% of my gross rent, and I divided it by the rough estimation of the number of hours I put into it, and it was like 140, 160 an hour is what I felt in this type of landlord's market I was saving by doing it myself. I mean, you know, call me old-fashioned, that's real money.
So Mark asked, how do you think the potential for appreciation compares between single-family homes and condos, given the big increase in building of condos?
Yeah, my best guess is that I cannot predict the difference. Over 45 years, statistically, it's been 6.3% appreciation for single family, 5.9% for condos. My best guess is, talk to me in 45 years when I'm 95. I think it's going to be about the same. So I would not buy a single family or a condo because I'm smart enough to tell you which one is going to appreciate more or less. I just completely, fundamentally, honestly tell you I can't predict that. If you can, I don't know, you're smarter than me.
All right, well, I'm looking at the clock here, and we are right at the hour mark. So I know, Charles, you got some things to do, and I'm sure a lot of the attendees out there have to get on with their day as well. So everyone, thank you for coming out. Charles, thank you for your time and presenting. And like I said, look for an email tomorrow with a link to the PDF slides and also a recording to this webinar, and also a link to our future webinars as well. All right, thanks everyone. Have a wonderful day.
Thanks everybody.